Hi, this is Jim Cunningham. I've got Phil Blancato from Ladenburg Asset Management, as well as Christina Lindsay Orta from Ascent Wealth Management. We are going to talk about market update. We are now in the hot and heavy Christmas season of 2025. So if you're watching this and you go, "Oh, all this stuff happened a long time ago," it's because we're recording this in December of 2025. We are recording it live. So this is real time and we record these live every Thursday, typically at noon Pacific time. So you can go to our website and sign up for one of our webinars. But what we're talking about here, first of all, you should subscribe to our YouTube page. We couldn't do this without asking you to subscribe to our YouTube page if you haven't already. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney for over 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, real estate broker, securities, insurance licensed, and a pilot single engine land, instrument rated, although I'm not current. And these are the attorneys in our firm. We are all things peaceful transfer of wealth from one generation to the next while minimizing taxes and drama and litigation. And yeah, you might have to put up with your jerk brother when you administer your parents' estate, but we're here to minimize the conflict, okay? We're also here to minimize taxes. We're here to help you increase multi-generational wealth, which is the topic of today. And it is what the certified financial planner team at Ascent Wealth Management handle. We have Christina here. Alyssa and Shannon are not joining us today, but they're hardworking helping their clients today. And this is a disclaimer, legal disclaimer. I'm a lawyer. I'm talking. This is not legal advice. If I say you, there is no attorney-client relationship. Okay, so I'm just saying you so that you understand these concepts. Christina and Phil are going to talk about a lot of technical stuff. I might stop them and say, guys, I'm not sure I quite understand this, and maybe somebody watching this might not understand, but really, please know that this is not legal advice. And Christina, do you want to discuss your disclosure?
Sure. This is certainly our disclosure. We are registered investment advisors with the SEC. We also have our broker-dealer, Cambridge Investment Research. And so we, as fiduciaries and certified financial planners, every bit of advice that we give has to be on an individualized basis and in the best interest of the client. So none of this is to be deemed advice, but we certainly want to provide an economic update that is more broad-brushed, and definitely don't take any of this as is direct advice.
Thanks, Christina. And with that, I will turn it over to Phil S. Blancato.
That's funny. Well, first, thank you very much for having me today. I greatly appreciate it, and certainly want to have an opportunity to interact and just kind of answer some questions about what's happening in the economy. I think sometimes, folks, it's the best way to look at what's happening is that there's reasons that you get drawn into watching CNBC or Fox or whatever network you might like or whatever you read. And let's not forget, sometimes fear sells a lot more than when there's positive things to think about. But the facts really are very different than what the headlines suggest. And just framing some things out there. There's a lot of misconception around the U.S. consumer. I'm 58 years old. I grew up in the 80s and 90s, watching a time when the U.S. had runaway inflation and very high unemployment. When you look at today's status of current unemployment, it's significantly below historical standards. When you look at today's status of inflation, it's significantly below historical standards. We look at wages and how we've done the last few, they're quite good. And sure, the battle of inflation over the last few years has not been easy, but today you think about what you pay at the gas pump versus what you paid a year ago. Think of what you might be paying for certain goods is cheaper than they were a year ago, and certain goods more expensive. The U.S. consumer today, which is the driver of the U.S. economy, continues to over-impress. And I'll start with some fun facts that I think you should take down and remember that 70% of the growth of the United States is predicated on how much we all spend. 25% of the globe's growth is predicated on what we all spend. Today, the U.S. economy is double the size of every other economy in the world, China being the next one behind us. The U.S. currency is far and away the default currency, and there's no doubt that that's not changing anytime soon. When people say that that's the case, it's just not the case. There's no country that could step in and replace us. But the reality is, when you look at the facts of where we are, just on Black Friday alone, the U.S. consumer spent $80 billion. The holiday weekend from Wednesday to Black Monday, or Cyber Monday, excuse me, was over $180 billion.
Wow.
Back to school spending was $41 billion. Halloween was $16 billion. The entire holiday season will be in excess of $1 trillion is the expectation. Famously, Macy's, a company that's really struggled for the last 5 years, came out and put earnings numbers that were far and above expectations just the other day. So this ongoing rhetoric around that the U.S. consumer is really going to have a difficult time because of tariffs just hasn't developed. And the U.S. economy is going to struggle because the tariffs just hasn't developed. And that we're going into recession, not the case. So what happens, the byproduct is that the stock market rips higher on this positive news, and yet the headline suggests something quite different. The bond market goes significantly higher because inflation has come down and the Federal Reserve has kind of come back to reality and where interest rates should be. So one of the best years for bonds in 10 years, arguably 20 years. So I think sometimes we forget what a euphoric market it's been for 10 years now, stock market, of returns anywhere on average 13 to 14%. And for the first time in a long time, a bond market that's giving you quite a good return. And what it leaves you with, why are the headlines so brutally damaging when the facts say something completely different? So I thought I would start there, Jim or Christina, and maybe I give you a chance to all weigh in as well, and we can go through some slides as well to kind of talk about it.
Phil, I got to tell you, you mentioned CNN. When you mentioned the news media, I watch, CNN, whatever, Fox News. I'm watching TV because I sit down. I'm 50. But how old am I? 56, I guess. Now it's kind of hard to keep track. But I watch TV. My kids are in their 20s. They don't really watch TV. Where are they getting their news from? TikTok? Like where are these younger people getting it from?
It's an endless stream of negativity for the same reason. And I'll give you a quick story. I'm lucky enough to be invited to speak on TV fairly frequently. And I was on with a famous commentator one day on CNBC. And off camera, we talked about, why always getting my opinion. Why not ask your opinion? The commentator was Bill Griffith at the time, who's since retired, very famous Wall Street analyst. And his answer to me was quite simple. My opinion is irrelevant. I have one job, and it's to sell cornflakes. So whether it's TikTok, set there's advertisements on the side, or Google, or CNBC, or Fox Business, or whatever, the idea is, how do we draw you in? You're much more drawn in when you're scared about the future of your money than when you're not. And for the younger generation, which is somewhat relevant in the investment world, not completely, to be honest with you. Today, of the assets in the United States, 70% is held by people over the age of 65. In fairness, there's two ways to look at the wealth gap in the United States. It's been a bit of a K-shaped recovery, and I can explain what that means is folks who had assets, whether it's stocks, bonds, or houses, are worth a lot more today than they were in 2019. Folks who didn't, still worth more, but not as much. Today, the top 1% of the U.S. economy, top 1% of our population owns 33% of the assets. The top 20% basically owns the bulk of it. The bottom 50% only own 3%, but the top 20% pay all the taxes. Anyone below $100,000 pays basically no taxes. So
and there's some slides that we have to go through some of that too.
Okay, perfect. So, and forgive me, I always like having a conversation with you all. To start, I can't help myself. I do this all the time. But I mean, to answer your question, Jim, I do think it's relevant that, we keep it to the facts. And the facts we can get into where I find facts, and maybe some of the folks on the call will do that. So why don't we jump into some slides too?
Yeah, let's jump into some slides. I think that I've had a chance to review some of these slides and sit down with Phil. And Phil and I have been working together for over a decade, and Phil helps us oversee a little over 300 million of our clients' assets, and so we respect his outlook. And news. I'm more Gen X, and I'd say that I'm on the youngest end of Gen X, and I don't watch my news anymore. It's all, and I've got the Fox Business or CNBC on during the day, watching just on mute what the market headlines are, so I'm aware of what my clients are seeing. But for me, it's Wall Street Journal. It's looking at my phone. It's reading my news. It's reading different economists. It's reading my news for the most part. And then you go to the next generation below me, and it's TikTok, Instagram.
Yeah.
But even clients that are now in their 60s are sending me Instagram headlines. So I think it is important to get through the fact versus fiction, because I think that that's really where the news media, whether it be TikTok, Instagram, there's always a narrative to push. And I think we really need to get to the facts as to what is driving the economy. So Phil, I'll let you kind of walk us through that.
I couldn't have said it better. And in the end, wherever your source is, make sure it has a factual backdrop. So let's start with tariffs. The baseline tariffs today are probably going to end up around 10%. Right now, the three negotiations that really matter most to the U.S. economy are China, Mexico, and obviously Canada. The reason why Mexico is the number one import country to the United States, number two is Canada, number three is China. That really started in 2016 and has accelerated. Now, it's important to understand that when you think about what tariffs mean to the US economy, I think the first broad brush was to fix some of the imbalances. For example, a Harley Davidson sold in India today has a 70% tariff on it. Bourbon whiskey from Kentucky in France has a 40% tariff on it. Yet champagne from France, the United States, is zero. So when you look at some of the imbalances, some of this had to be fixed. But ultimately, I think where the administration is slowly getting to, which is tariffs to fix some of those imbalances. Be careful the tariff issues, items that we can make as a country and not the tariff things that we cannot. Coffee, for example, which was some of the inflationary concerns. So you see some realignment as we go through this. There's 10,000, in excess of 10,000 different items that they're being reviewed from a tariff standpoint. But I think it looks some of the things that have been rationalized, whether it's the agreement with Switzerland finally that has in place, some of the European nations that have come and lined up like Great Britain, the agreement with Japan, the tentative agreement with Mexico. The bulk of it's resolved. And what I mean is, as we move past this, for the average person out there, it's probably not a significant impact to how much it costs. Let's go to the next slide. When you think about how we evaluate tariffs and whether that's going to affect us, there are certain things that we buy every day that matter a lot to us, and it might be a bit more expensive, like your cup of coffee. And then there are certain things that will not, like the energy for your home, which is up for a different reason. Uh, Famously across the United States and around the globe today, you have two ways to look at energy. That energy in and of itself is more expensive today in the United States, and that's partially because of data centers. In New Jersey, where I live, we're up 19% year over year. And that's because data center demand in New Jersey is drawing power. Yet the United States is 50% cheaper in power than if you were in Germany. So when you think about tariffs and what it means is in the United States, we can control our energy costs because we create a lot of it ourselves. There are certain things like imported goods here in yellow that are gone up a bit. And you'll see it in clothing, for example. And what we found in the price of clothing is one third is being absorbed by the manufacturer, wherever that might be, one third by the distributor, Macy's in this bad example, and one third by us, the consumer. Let's go to the next slide. So ultimately, what it means is that the average consumer out there is going to feel an impact of about $500 to $800 a year. But the same token, counterbalance that with lower gasoline prices. And it means the net impact of the average US consumer, depending on what you buy, is probably going to be about $500 more in overall costs increase. But there are other negligible items that we think will ultimately come down because of it. And for example, what does it mean for the United States? If you think for the US, and if you ask me what the number one worry I have for the US today, it is clearly the size of the US government's debt. And if you look at every country in the world today, every developed country in the world, everyone's in debt. And most of them are spending more than what they make. Now, I care about something called the net debt. That's if I take the total debt of the United States and subtract what's at the federal government, the net debt is basically for every dollar we make, we owe a dollar. If you look at every other developed country in the world, no one else can say that except for Germany. They're the one country that is in, but they're about to go on a spending binge because they haven't done that in a long time. Will tariffs help us? The irony of the United States is today, tariffs will have a little bit of an impact. In 2024, tariff revenue was $77 billion. In 2025, it's probably going to be about 300 billion on an annualized basis, depending where everything settles out. But the reality is the bulk of the revenue in the United States comes from income tax. That's the blue line there. And when you think about where the United States sits today, then you can go next slide, Jim. That's fine.
Yeah.
When you think about what it means, what I care more about for the long-term health of the United States, and even in the short term, today 13% of the federal government's budget is spent on just interest payments. Imagine if you bought a big house and you had a mortgage, and that mortgage had a high rate of interest. That's what we are today. You're paying a lot in that interest payment just to live in that house. The United States today, it's basically tied to be the second biggest line item on the federal government's balance sheet. Or put a different way, we spend as much on interest payments on the bonds that we've issued as we do on things like Medicaid or Medicare, defense, things that are quite incredible. So when you think about the impact there, it matters that tariff revenue help bring that down a little bit. We've got a lot to figure out from how much tax we pay and can we grow the U.S. economy to where this becomes less of an issue. Let's go to the next slide.
Yeah, Phil, I have a question on the net interest payments. Somebody is holding those bonds. Somebody or some entity or whatever is getting essentially the interest income, the interest payments on the bonds. Who are those people? Who are those? Are they countries? Are they individuals? Are they, people have to pay income tax on this if they're certainly an individual. Walk us through who holds the federal
A great
debt.
question, Jim. I should mention it. There's a lot of belief up there that China owns the bulk of our debt and places like it's just not true. 70% of American debt is owned by us, Americans, pension funds, individual Americans. So we own our debt. And we continue to buy our debt, whether it's in your 401k, in your investment account, or in a pension, whatever the case may be. It is while China is our second biggest debt holder, they're 5% of our debt. Japan's more 6, and the rest of the world makes up the remaining, call it 18, 19%. The debt is owned by us today. But the problem is, when do folks get tired of adding more to the debt? It's one thing to say who owns it today. It's a whole other thing to decide as we add more to our debt. And today, if you look at the outlay there, 6.8 trillion is what we spent in 2024. We only made about 5.2 trillion. So we're still spending more than what we make. And to fix that, it's a combination of, let me digress just for a second. I believe we're in an economic experiment. It's really important to folks who listen to track this for a minute. There's one of two ways I think this works out. I think it's one of the most unique moments of my 35-year career. If you believe that deregulation, which is happening right now, it's why I see bank stocks doing so well, especially for small regional banks. And if you believe that lower corporate taxes, because that's what primarily was in the big bill, and lower taxes on the average person, Social Security, overtime, taxes, SALT taxes on the East and West Coast, if you believe those are stimulants, and we do, and then most importantly, that the ability to immediately depreciate any money a company spends, which is a fancy way of saying, if I own a factory that makes widgets and I build a brand new factory right next door and I spend $1 building that factory and I made $1 in revenue that year, my net tax to the federal government is 0. And why that's so important, it allows corporate tax in the United States to come way, way down. Now, in fact, let me go back one slide. There's something I do want to point out that it's terribly important. I think sometimes we get all worked up about this and it's almost irrelevant. You see that gray bar? 530 billion of our total revenue is corporate tax. It's almost nothing. If I would argue, if I could wave a magic wand, if we made it 0, we'd be a much healthier country. Why? Because lower corporate taxes would mean higher wages and greater growth. If you think about Ireland today, which is the fastest growing country in Europe, they have 12% corporate taxes. Why? Every major company in the United States wants to go to Ireland because they want to pay lower corporate taxes. GLP-1 drugs are made in Ireland. So go ahead, go back to one. Go forward one. My point is, when you think about this experiment that we're in, if lower corporate taxes, lower regulation, and then stimulants in the form of kind of lower taxes to the end consumer, or the flip side, that we do not grow significantly, that tariffs become a headwind, the deregulation doesn't spur more borrowing, and this depreciation doesn't create a renaissance in U.S. manufacturing, which so far we've got $500 billion spent on new factories in the last 18 months. You're now making NVIDIA chips in Arizona. There's 2 trillion more to follow. AstraZeneca is a great example, and I'm not recommending this stock. It's a great cancer fighting company. They're predominantly based in Europe. They're now 50% of the revenues come from the United States. They're building a brand new plant, a 5-year plant in Maryland, to the tune of $5 billion to build this plant, which will employ 10,000 people with average salary of around $100,000 a year. That's incredible. So you're going to make cancer-fighting drugs in Maryland when we used to make them overseas, as an example. So my point is, I think the experiment works. So one of these two says, if it doesn't work, we do not grow the size of the U.S. economy. Our interest payments become a real headwind, and we start to look like Europe of decades of no growth. Or we can grow the size of the U.S. economy to 35 trillion, to 40 trillion, to 45 trillion. And if you could just hold your debt steady and grow the size of your revenue, well, then guess what? You fixed your debt problem. So it's kind of fascinating that this experiment could be really indicative to where the future of the United States goes. And this isn't a long experiment. This is the next 12 to 24 months that we're going to find out if this works or not.
And I know we have a lot of slides to get through, so I want to make sure we get through some of them. But while we're on this topic, I don't think I saw a particular slide on GDP. And I think it's important to note that while I think a year ago, if we looked at most of 2024, a huge percentage of our GDP was from government expenditure and government spending. And right now, our GDP makeup is very little government spending.
Correct. Our biggest issue, and you're hitting on it, is Social Security. If we had the wherewithal to take the age that you can begin to take Social Security from 62 to 65, that would fix another major debt problem. Europe has done it. Europe is now 68. Now, granted, there's a lot of fraud in their system, but if we could just age adjust Social Security to 65, and to your point, Christina, to limit the stimulus, because the stimulus is what's caused so much of this debt over the last, really since 2008, decades of government overspending in the United States put us in this scenario. We need to have fiscal responsibility and we need to make more money. And I think that some of the regulations should aid to that. And then to your point, we do not have a major stimulus package doing that. Now, will lower taxes create more debt? Well, that's the argument. That's the contra argument that the lower taxes will add to our debt. I would argue the lower taxes will grow the size of the U.S. economy and make it better. Let's go on, Jim. Christina's like, we got a bunch of slides. Skip this one. Let's go to the next one because the government shutdown's over. Keep going. So I do think it's helpful to know where inflation has sat and where it resides today. And there are things like beef. It's a great story about American beef, which was for decades some of the biggest beef producers in the world. We've lost that leadership role. Some of it is to a disease in Texas on certain cattle that can't be brought to market. Some of it is drought conditions that haven't led to enough grass for them to graze on. And some of it, I would argue, never let a crisis go to waste. Because when beef prices increased, for the less cattle you have, but you're making more money, it's obviously more productive. So what happened? So we had a tariff with beef on other countries around the world. We realized that if the American producers don't want to amp up the number of heads we have, well, then lower your tariff on Argentina to bring in Argentinian beef, which is what's happening right now. So you're seeing some of these areas become more expensive. But notice on the bottom there, gasoline down, eggs down, fruit, apparel, and some IT services. So this leveling off, I think, is very powerful. And some of these things can be affected by tariffs at the administrative level and growth of the U.S. economy.
And I
So
think two those things that you said at the top there, the home insurance, hit hard here in California in particular with all the fires. So home insurance, and I think that's a lot regulation based. But then you also spoke about the electricity, large component of that being the data center, AI, GPUs, and all the data that we're consuming. The electricity rates are up, probably more consumer behavior related than it is, and employers using more electricity than it is necessarily something we can control.
I think that's right. And that's why will we as a country decide to generate more of our own power, whether it's nuclear, gas, or will we be reliant on where we are today? The power cycle over the next 4 years will be significantly more, where data centers in the United States will take up as much as 12% of the American electrical grid, where today they take up 3%. So we've got a problem in our hands. We are all in on AI, and people are getting upset about what they're paying in electrical bills. So there's something has to give here. And the head of NVIDIA just came out famously and said we're going to build small nuclear reactors all over the country to solve this problem. And I think he's right. Here's why I love that idea. That's American manufacturing, and more importantly, construction is the single most accretive, most powerful thing to grow the U.S. economy on a percentage basis. Maybe a fancy way of saying, when we build stuff, it's very productive for the U.S. economy because you're employing workers, you're using concrete and wire, a lot of that stuff we still make, and you're building things here in the United States that can be very powerful from a stimulant. So if that is the case, that we have an energy renaissance, then I think it could be very powerful for the U.S. economy. Let's go on to the next one, Jim. Our price is contained. Unfortunately, we've seen in certain markets that recently there's been a resurgence in some mild inflation. So we look at something called ISM services. That's basically a gauge of how much the consumer is spending. And if you look at where CPI is today and where services are, and the recent data point came out just yesterday, still up a bit. But I just think it's normal. And I'll give you an example of what I said earlier. I grew up with 4% inflation in the United States. Today, the inflation rate is arguably 2.75 to 3. That's still 25% lower than what it was historically. And we did just fine in the 80s and 90s with 4% inflation. So I'm not petrified by 3% inflation as long as the unemployment rate stays below 5 and we get a growing U.S. economy. Let's go to the next one. There is some signs that we're seeing real stabilization, and what this means is going back to normal. So this is the labor market. Basically, the labor market's at equilibrium. For every job we're losing, we're adding a job right now. We're not seeing pressure in the labor market, anything of significance. What we're seeing is some of the excess hiring of the post-pandemic world come off a little bit. So that's why things have gone back to normal. But for all the retirees we have enough bodies to replace them today. We'll probably need to fix our immigration system. We need immigrants, a minute 1.5 million to 2 million a year to come through in a process where we have in different sects of the labor force. But certainly today, getting back to a level labor market does something very powerful, good and bad. Let's go to the next slide. I care a lot about wages in the United States. So while unemployment stays low, and this goes back to that, see that 6% number where the blue line begins way back when, that's where we were historically. And now we're at this 4% number, which is really quite good. Go to the next page, Jim. What I think is powerful is you're not seeing any layoffs today. Notice the gray line there. That gray line very stable, the blue line stable, the red line. These are the survey responses that we get from companies that suggest that so far there's not a great concern in the amount of people being laid off. Now, one thing that is kind of damaging, we have less companies responding back to surveys than we have in the past. I still think that that is important. I just wish that we had more companies responding back to us.
Why do you think fewer companies are responding?
Because the system is archaic. We still do it by mail.
Oh, mail?
Mail. When we survey companies, a phone call or mail. And
okay, enough said.
So go to the next one. So one of the things I take a close look on is how strong is the U.S. consumer. So I said earlier that the labor market is good and bad, it's flattened out. One thing that's very powerful is wages. And then wages are directly connected to sentiment. Now, ironically, when do people feel positive about the economy? When their political party is in power. And notice the red line, when the Democrats were in power back on from 2017 to 2020, they were very positive on the U.S. economy. When the Republicans are in power, like they're very positive. So sentiment isn't super relevant to economics. It's something we keep an eye on, but it is kind of fun to talk about. Go to the next one, Jim.
I think it's an important point, though, because I think that that's one of the things that, a president controls very little when it comes to reality. There's if you look back at the last however many decades, there's money to be made when Clinton was in office. There's money to be made when, W was in office. There's money to be made when Obama was in office. Even during the Great Recession, there was money to be made coming out of Obama and looking at Trump 1 and Biden and now Trump 2. You can make money in any different environment. If you're out of the market, you're the one that loses. But that's
exactly
really where
right.
there is such polarization with all this information that's fed. And depending on where you get your news source, you're fed in an echo chamber constantly with information. And then that's where you have to separate facts versus fiction, because your emotions start driving your economic viewpoint. And that's really dangerous when we're not looking at the data. So that's really why we were trying to spend some time here, because I think most of the comments I get from a client, is emotion driven based on headlines that they're being fed based on their political viewpoint. And I think we have to kind of try to find a way to strip that out and drill down to the real data.
I mean, perfectly said. I like to say the market doesn't love you, so don't love it. Don't be emotional about the market. And the last thing you ever want to do is let your personal or political beliefs get in the way of investing. The reality is the stock market is up 3 out of every 4 years. And if you have any time, I like to say risk plus time equals reward. Really simple. The more risk is basically how much volatility can you stomach, ups and downs. Time, how many years can you give your money to grow? And that's how you make money. That's how you get to your reward. And if you let your personal preferences, for example, I have a family member who's not a pro-current administration. And literally 6 months into the new administration, when we had that really turbulent time there in that April, May time period, she called me up in mad panic. I'm going to liquidate my 401k. I can't handle all this. And I point to her was, listen, you got to strip out the headlines of this stuff from the facts of the economics. Because if you leave the market and it rebounds, you're going to really be kicking yourself. And thankfully, I was able to convince this family member that long-term things are going to be just fine. All the reasons we've already laid out today. And they stayed invested. But that's a great example of panic is what people like me take advantage of. To be specific, when the market sells off in a time like it did back in the early spring there, we take advantage of those opportunities. You buy more stocks at that moment. You get things on discounts. Like go into your grocery store and that really nice piece of filet mignon you've been dying to get suddenly on sale and you get it cheaper. Well, then you buy 2 of them, not 1. That's the mentality that we know the market historically is up. U.S. economy is growing, not contracting. We lead for fun. There are 10 excess trillion-dollar companies in the United States, 10 of them. Nowhere else in the world is there a trillion-dollar company. Nowhere else in the world is there a half-trillion-dollar company. Some of the Chinese companies are a little bit fuzzy. I'm not sure I trust that math, but especially in Europe. My point is the U.S. economy, specifically because of AI and the diversity of our economy, the uniqueness of it, is far ahead of the rest of the world, regardless of what administrations do. Economics are cyclical. They go round and round. And to Christina's point, if you get passionate about your personal beliefs, you're going to panic and you're going to make a mistake. The best advice I can give you is, for one, you're working with two experts, so they're not going to panic, and that's what good for you if you're working for them. I hope you are. If you're not, you should be. But if you panic with your money, you're going to lose. It's just that
Phil,
simple.
Phil, I have a question. 493 of the S&P 500 stocks are kind of like, eh. There are seven stocks that are driving a lot of the return, a lot of the market, the world market capitalization. Are those companies too big to fail? Is Nvidia too big to fail? Is Google too big to fail? And how they're investing in each other with AI, this has been in the news in the last couple of months. You know what I'm talking about? With
No, for sure. It's a great question.
is this just running something up? Is this a sign of a bubble?
I think we have a
What
couple
what
slides
do
on
you,
that too, if we can
okay,
go through, but
good.
I think it is important to talk about, I think the question
I,
of are they too big to fail is an important question.
Yeah.
it is, and we'll hit that at the end. I think that's a good one. Let me bang out a few more slides, and we'll go to that. No, go back to that one. That's an important one. If nothing else, everybody, I want you to leave today with go back one slide. I want you to remember this slide, and this is probably one of my most important of the whole deck. You
Hmm.
see those blue lines? That tells you when wages were above the rate of inflation. When the United States made a deal, and basically the whole world did, especially Europe, to take manufacturing and send it somewhere else in the world to import cheaper prices, deflation, it created decades of no wage growth. You know what's kind of fascinating and it's not really talked about? 8 out of the last 10 years, wages are above the rate of inflation. The average annual income in the United States now is closing in on $70,000. Average family income before is $130,000. You have a scenario where the folks who make less than 100 grand a year have had a significant liftoff.
Mhm.
So when I hear people complain about inflation, I go, I get it. It sucks. It's not fun. But guess what? The byproduct of inflation has been higher wages. Now, I live in New Jersey. Our average McDonald's worker in New Jersey makes $19 an hour. I bet it's the same out here in California.
It's
So
20,
my
but yeah,
point is, what's that?
it's 20 because it's state law.
Okay.
But anyway,
So you have to ask yourself when you look in the mirror, are you okay with paying a little bit more prices with the fact that some of that went to wages? And that means you have a better, more healthy U.S. economy, which I hope translates to a better housing market, more buyers, and most importantly, more babies. We need babies. Why is Europe in so much trouble? They don't have babies. Why is China in so much trouble? They don't have babies. We still do. We need a positive population growth to continue us to be who we are. And economics connect to family life. If you make enough money to be happy, you're more than likely going to have more babies. Babies matter. So I think this is one of the most powerful things in the whole deck that wages have been quite good for a long time. And what's happening now is they're slowly coming back to normal now. We were growing at about 5% wage growth, as you can see from that purple line, falling back down to probably around 3.5 to 4%. But as long as they stay above the rate of inflation, I'm very optimistic on the U.S. economy. Go
I
ahead.
this is I agree with you, Phil. This is probably the most important slide that wage growth is continuing. Like as you say, this drives the economy. So I'm really glad to see that.
So this one's my answer to the folks who say, are we going into a recession? So when you see some of this, you go, oh my gosh, look at the blue line, credit card debt, near all-time highs. This is the delinquent payments of the last 90 days. Look at student loan back. Oh my gosh, 10%. That's terrible. Worse yet, auto loans, 5%. That's terrible. Notice that light bronzish yellowish line. It's basically zero. Well, that's mortgage debt. Now let me show you why this is important. Go to the next slide. The only thing that's really relevant to the U.S. consumer is mortgage debt. So notice that lime green section on the upper bar. So on that upper bar are all the liabilities, the debt that the consumer has, $20 trillion. But guess what? 67% of it is in mortgages. So student loan debt, credit card debt, auto debt, not a big deal. Now, here's the real fascinating point. Notice the line on the bottom. That's what you're worth. Collectively of the country, $190 trillion. So if you take the amount of debt divided by how much we're worth, it's the lowest ever, ever. So why is the United States not going into recession? Because we do not have a mortgage crisis. The banks are in great shape. Houses are in high demand. The changes after 2008, I actually think they were a little too much, but they worked. So yeah, we got a little student. By the way, student loan, auto loan, and credit card are kind of back to historical averages, so not a big deal. So
Yeah, a
why
lot
is
of
it?
that too is they're back to historical averages. We had student loan debt forgiveness for that period of time where it was on
Yep,
hold during COVID. And so you're seeing these
Yeah.
increases on a year over year basis. However, they're just getting back to historical norms. So this isn't like, oh my gosh, they're rising, the sky is falling. They're getting back to normal.
that's
And
exactly right.
ratio wise, the asset balance sheet of the average US consumer is very healthy.
And also,
And
student loans aren't a bad idea. Like, I mean, right? Because the idea is you get a student loan and you don't, go to a not even a semester of some random for-profit school and get screwed out of your money. But people who get a medical degree or a legal degree or a 4-year college degree that might not otherwise get that, right?
yeah,
That's a net
absolutely.
positive on the economy.
That's
Yep.
exactly right. But and to Christina's point, notice the value there. The assets were now we could have a contra conversation someday about did the United States creating so much debt feed that asset line? It did to some degree.
Sure.
But conversation for another day. Let's go forward. So this goes back to what I started with earlier, just on wealth. If you look at the bottom 50% there is that little blue line on the right with 4 trillion, and the top yellow and dark blue are basically the top 1%. But the next slide kind of tells you the good with the bad. And while on one hand, I agree that the wealthiest did much better. The top 1% pay 40% of the assets. The top 25, top 20 basically pay all the tax in the United States. So here's an interesting fact. This year, $1.8 trillion will move from the boomer generation to the Gen Z, Gen X, Gen Y. Over the next 10 years, it's $190 trillion. That's probably an exaggeration. It's probably more like 100 trillion is what we're going to see. So I would argue that while today it's an imbalance, I think we're on the precipice of a gigantic wealth transfer that will change the economic landscape of the United States. It'll have debt destruction, take money from the parents, give it to the
Yep.
kids, they paid on debt, take houses from the parents, give it to the kids, they have a place to live. All that will go to multiple generations. The federal government will make some money on it in some cases, but Jim's going to prevent a lot of that. Good job, Jim. And the reality is the money coming over, I think, changes the entire economic landscape of the United States. So as long as we begin this process accelerates how we anticipate, I think it's a very powerful stimulant to come. And I'll give you one provocative idea. Where today houses are more expensive than they've ever been, the amount of money we make versus the amount of house costs, that ratio is the worst ever. It's very hard to buy a home. In 5 years, I'm going to bet it's the best ever. Why? Because as boomers pass away and their houses come to the market because they decide to live their lives in their homes rather than go to an assisted living facility, you're going to have a glut of homes begin to come on over the next 10 years. Fascinating that's going to change the economic landscape of houses and economic landscape of money that's to be inherited.
Phil,
Real
I have a
different.
question. Phil, has anyone done a study on how people spend inherited wealth and correlate it with the amount that they inherit? Because anecdotally, what we see is if mom and dad die with a $5 million estate and each kid inherits $1 million, most of these people are paying off the mortgage. They're retiring, so it gives them the opportunity to leave the workforce. Has there been a study on what people who inherit, how their behavior changes after an inheritance?
The problem is that all the studies I've seen, they're no longer effective because of the amount of wealth that's been created by seniors. Their home is worth double, maybe triple what they expected it to be. Their stock account double or triple what they expected it to be. So now that because the wealth is bigger than it's ever been, that you think about your average investment account, what's done the last 10 years, if you're properly invested, and most are, then you have a scenario where now what happens with those studies, I think, are not relevant. And I think there's a question in queue, which is a fascinating one. I would actually defer this one because I think this is a tax question. I know, Jim, you want to take this one. I actually really like the question. I know how I would answer it, but I'm curious how you would answer it, Jim.
Well, Hannah asks, a lot of seniors will move to care facilities and the houses will be sold too early and pay a lot of taxes, and the beneficiaries will not do as well. Yeah, I would say, Hannah, that's true if the person that goes to the assisted living chooses to sell the property and doesn't do something else. And that it's something Christine and I help clients with. But most people would, if they go to assisted living, end up holding that property until they pass away. And then when you pass away, you get that adjusted cost basis in death. If you were to rent the property out and you go to assisted living, once it's a rental, you can then effectuate a 1031 exchange. And that's something that Christina can help with. You can buy another property, you can go into a managed portfolio of properties that Christina can talk about. But there are ways that you can do that. And unfortunately, I met with a client over the last couple of weeks. We've had several meetings, and this client didn't do all the things that they should have done in the time they should have done them. So they're having to pay maybe $100,000 more in income tax this year than they otherwise would have. So I would say, Phil, absent, competent advisors, yeah, people are going to be in trouble, Hannah, on
Sure.
on paying taxes on selling the family home. That's why you need to meet with your A team, your CPA attorney and certified financial planner.
Sure.
That's exactly why I thought and you can come to these two. I mean, this is
Yeah,
exactly why you're listening to get
yeah,
options to
right.
mitigate that. Economically, by the way, Hannah, fun point. We expected 90% of boomers to be in transition or ready to an assisted senior living facility. Believe it or not, the number is only 10%. What
People
are
are living
senior?
much longer.
What's that?
People are living much longer and
Much
and
longer.
and and healthier than was forecasted.
And the expectations, they would much prefer to live their lives in their home. So
Yep.
we're 800,000 people short in assisted living facilities,
Mhm.
at home care. So it's just quite incredible that the economics changed what we thought was going to happen
And
with
Phil,
seniors.
just a quick, totally anecdotal story. My wife and I sold when our three kids finally left the house. We sold our big house, our 5 bedroom house, and we moved to a smaller home. The people who bought our home were, I think, in their early 70s because they had downsized, and then their grandkids started coming back, and they're like, "We need more bedrooms for these grandkids. We're tired of them sleeping on the floor in the living room." So I think, maybe people, as they're thinking about how people are going to spend money in the future, you have all these sort of, I don't know, maybe unforeseen twists and turns. But to your point is the baby boomers, I find that my clients want to stay in the home, even if they're spending 30, 40,000 a month for in-home care. They want to stay in home. They don't want to go to assisted living.
And that's why a lot of the long-term care policies that we write, and we do, long-term care planning, we've done webinars on them, and we'll certainly do one again, but making sure that they provide for in-home care. So that's important. So I think we have just a handful of slides left, then we can certainly open it up more to Q&A. Um,
Yeah, we could go through this pretty quick. I talked about the wealth transfer. We can skip on to the next one. There's
Actually,
quite a
I
bit.
just I just want to mention one thing.
Go ahead.
If you're watching this video and you're like, this is me, I'm a boomer, I'm retiring, and gosh, when I pass away, this wealth gets transferred. Something you really need to think long and hard about is, do you want your future ex-son-in-law or future ex-daughter-in-law getting their grubby little hands on what you took a lifetime to create? There are planning strategies to stop that from happening. Half of marriages end in divorce. So if you have a child that's married, there's a probability there, whatever it's statistical probability, that that child will be divorced. If that child inherits money and then pays off the mortgage that on a jointly held asset, is that, does that change the rights to the property? Yes, it does. So this is really, really important to pay attention to this in estate planning. If this is important to you, talk to your lawyer about it.
Can be said better. I talked about this earlier. The spread between the costs of a home and to buy a home today is the widest it's ever been. I think that changes, but today that's a restraint on the U.S. economy. So it's just something to think about that we're not quite through this problem yet. Go ahead, Jim. There is a change coming as boomers begin to move on, unfortunately, and we're seeing in places where we have a traditionally older age population, for example, Arizona and Florida. This would be Florida. We're watching the average price of homes come down recently, not go up because there's more supply coming to market. Arizona is even more emblematic of this recently. So we're seeing that change. And finally, just get through my last book on the shelf to keep it from facts and fiction. Just some things to talk about. We do think the stock market goes back to averages. We've spent the last, call it 10 years with above average market returns. I think the market returning around 7.5 to 8%, which is done over the last 100 years, makes a heck of a lot more sense. As we get back to normal earnings cycle, normal government spending, Katrina mentioned earlier, normal government spending, normal earnings gets us back to normal stock market returns, which finally opens us up to other things like international stocks eventually, maybe emerging markets and commodities, different types of investments that could add value.
What are we looking, what is this that we're looking at? We're looking at the trajectories of the S&P 500 returns for the last 35 years. I see an
Intra-year.
average. I got you.
So
So we dipped in the beginning. Okay.
exactly. So those gray
How much
lines,
dip you have?
exactly. So you'll have lots of volatility again. The gray lines represent each individual year. See 2008 there, way on the bottom, 1995 way on the top. That's that individual year. The blue line is the average. So we're going to go back to historical averages.
Great.
Just one thing about the current market, why I think it goes back to averages. We do care about prices of companies divided by how much they make. And today, those averages, that's the yellow dot there. Every single market is pretty much expensive. What do you do at a time like that? Own some bonds. Bonds are up 8% this year. Nothing wrong with a balanced portfolio. Sell a little bit of Nvidia. It's okay. You can take some profits. Sell a little Microsoft. It's okay. You can take some profits. We have ways to mitigate the impact of taxes, but it's a good idea to be diversified in your portfolio because the market's had one heck of a run for a long time, and stocks are not cheap. Jim mentioned earlier the AI bubble, if there is one.
Oh no, I didn't say AI bubble. No, no, no. Hold on.
Let me
I had
phrase
said
that.
too big
The
to fail.
concerns about an AI bubble.
Too big to
Forgive me.
fail.
Too big
Too
to
big to
fail.
fail. So on the right is just those Mag 7 you've heard so much about. You know what's fun? If you look at the 432, so 432 companies on the left equal 18 of the Mag 7. As I mentioned already, a lot of trillion-dollar firms in there. Imagine the companies that are in that 432, JP Morgan, Lowe's, Home Depot, GE. We can go on and on about some massive American companies, Procter and Gamble, so on, that are in there. You don't even think about it. For example, NVIDIA today is one of the largest economies in the world.
Bigger than
$5
California.
trillion puts them at about third. I mean, it's quite California, where you live, is the fourth biggest economy in the world. So I think sometimes we forget about the size and strength of the U.S. economy. My point is, the Mag 7 got us to a new industrial revolution. And to answer directly the question, is there AI concerns? There will be winners and losers in the AI space. Micron Technology is a great example of companies who had lots of volatility, and they're directly going to have success, I think, because of what the other companies are doing and how they're being used. But with that becomes, when does the supply and demand change around it? Today, there's $400 billion going to be spent in 2026 just by those Mag 7 and the rest of the world besides the United States. Those are real stimulants about money being infused into the global economy because of AI. Every country in the world is building AI data centers. And whether you've used ChatGPT or Gronk or Gemini or whatever yet, someday play around with it and you'll find how powerful these things are. So I do not think it's an AI bubble. I do think there are some companies that will win and lose in this. And that's why you need to be active in your portfolio. NVIDIA is not going anywhere. Does Intel make sense up here at $47 a share when it hasn't yet even entered the space? Well, that's a different discussion. So I think we have to be smart about where you make your bet. But the reality is, the revenue that these companies are generating today is so different than the 2000 tech bubble when they weren't making any money. Where today these companies, think of it this way: the average profit margin on the S&P 500 historically is 8%. How much bottom line money they make? Today it's 10. NVIDIA's profit margin is 32. I mean, it's mind-boggling how much they make. Microsoft is the single most important company on the planet. Why? Because every day when you turn on the lights in your home, start your car, use your cell phone, or turn on whatever equipment you're using in your house, from a washing machine to a dryer to a blender, there's probably a piece of Microsoft technology in it. So my point is, I think it's unfair to categorize it as a bubble. I do think there's always winners and losers. If we go back to the tech boom of 2000, many of those companies still exist and did quite well. So it's just a matter
But
of
the
being
key
smart
difference
about it.
was they didn't have earnings. And I think that
Yes.
that's really where people get too focused on PE, which is simply a division equation, the price earnings ratio. And people go, well, the price earnings ratio, it's overvalued. Well, growth stocks are always overvalued. But the point being is they have earnings. And if they don't have earnings, there's concern, but they do have earnings. I do think that, to your point, there's going to be winners and losers. We just saw Google could be a real competition if their chips and, GPUs start to compete with NVIDIA. There's some real pressure of Google putting pressure on NVIDIA. And I think the AI reports just came out and Google really leapfrogged to the top. So you're going to have people leapfrogging for a little while. But I do think that what I'm hearing is that the Mag 7, you're going to see a lot more broadening out in the S&P 500 over the next 24 months, whether it's in the next 12 months or the next 18 to 24. I think you're going to start to see more breadth because every company is doing AI.
And to your point, you got to think of it this way. Right now, 40% of American companies are using it 20% or less. In 3 years, 80% of American companies will use it 40% or more. So it may mean
Bill, how can companies not be using AI? I got to tell you, I talk to lawyers. We use it ethically. I'll make sure there's certain legal ethics you have to comply with on AI. I use AI, if not every hour, probably every 2 hours. I use it a lot.
Mhm.
I talk to lawyers. They're like, yeah, I haven't even looked at it. I'm thinking, what? The lawyers who use AI are going to replace the lawyers that don't use AI. The companies that don't embrace AI are going to replace the companies that choose not to. I mean, and that's just going to be, that's horse and buggy to internal combustion.
Yeah, it is. And I'd go so far as to say the reason why you're not seeing significant adoption is there's still 60% of results have some hallucinations in them. McKinsey was famous about having a scenario where they were
Yeah.
sued by the government of Australia because they used them for a pension fund analysis that had some mistakes in it. So I think it's still early. And that's why not everyone's using it. We don't really know how to apply it yet to make sure the results are clean. It's simply another tool. And for
Right.
anyone to rely on it holistically would make a mistake. That would be very dangerous. We're not
Mhm.
there yet. It's certainly, someone described it to me as smart as a bumblebee's brain at this point. Because the idea that it can fly, it can land, it can help you be more efficient, it can know which way to go, but it can't solve a mathematical equation. So if you were a bee, for example, my point is it's beginning, but it's not quite there yet. And there's winners and losers in this. But to Christina's point, hit on something very powerful. What if you ran the local grocery store and you had 5 stores and you're able to manage your supply chain more efficiently or your budget by using AI? What does that mean? The translation into the rest of the market broadening out and other companies having better profit margins because of AI, that's the excitement.
Yeah, the
So
other bottom 432, you've got Walmart in there, Costco in there. And if they're starting to improve
exactly.
their supply chain through AI, every company's using AI and they're going to have potentially greater earnings growth. So I think that there's a real exciting story here.
When's the last time there was a meaningful, broad-based change, whether it's technological, that really bumped up profitability in companies? That was really meaningful. Was it like the internet? Was it cell phone? Was it the personal computer? What were the technological shifts?
2012 to 2016 when we had real adoption of the internet. Think about it. The internet came out in 2000, but fundamental adoption began post the financial crisis.
Mm.
And that's when you saw, if you look at American productivity standards today, for the average American worker generates about $145,000 per hour in productivity. I'm sorry, $145,000 per year in productivity. Average Chinese worker is about 15,000.
Oh my
That
gosh.
changed significantly starting in about 2010, 2012 forward.
Mhm. And I
So
think we only
10
have a
times the
hand.
wait a minute. American workers are 10 times as productive on a,
Yeah.
oh my gosh, wow.
Yeah. And I
Look at
think
the
we only have
size
a
of your
handful of
GDP. Do the
slides
math.
left,
Yeah.
Jim.
The math of the size of our GDP divided by our population. All
Yeah, I
right.
think we have a handful because I know we have a hard stop at 1, so I just want to like fly through these
Yes.
last
Yeah,
few
sure.
slides, and then we can make sure we've got time for Q&A.
Just I think small caps would represent a great opportunity as interest rates fall. Interest rate sensitive securities, lower interest rates, more profit, better AI, more profit. I think small caps represent a wonderful opportunity in the marketplace. You see how they've rallied in the last quarter here. Next slide, Jim. Earnings wise, earnings tend to expand significantly when interest rates fall. This is what we expect to happen to smaller companies. It's why in portfolios we manage today, we increased our allocation to 15% in small caps. Next page, next page.
And small cap means what? For those
Companies
who
that
are,
make less than $5 billion a year in annual revenue. About
that's
that.
small.
Yeah.
Less than 5 billion in revenue, small.
Yeah.
Okay.
I do think for those of you who are not buying municipal bonds for a first time, and I know they're boring, but I love the bond market. And when I can get a California municipal bond for 5% and not pay any federal or local tax, it's a real yield of 8. It's set it and forget it money. I love that opportunity. Let's go to the next page. Defaults are never an issue in municipal bonds. I know some folks worry about defaults. It's really something that never happens. U.S. corporate defaults on the right are 29%. Munis historically are only 7. And even when
Yeah.
there's a default, you generally still get your money back. You just don't get your interest payment.
Yeah. And most of our clients were doing, A-rated insured school
Right,
districts, water districts, toll
right.
roads, airports. So
So instead of getting 5, you might get 4. I just thought this is powerful. I get this question a lot. Is AI going to take away jobs? Technology has always taken away jobs. Going back to 1978, that would be 38% of the American workforce was in routine occupations. Today it's 24, probably going down to 15, maybe even 10. But think about the jobs that are going to be created in the building of a data center. Wonderful article in the Wall Street Journal yesterday about the incredible amount of construction jobs that are being created about building data centers, and that's not
oh yeah.
stopping. The regulation of the data, the compliance of the data, to making sure the data can get out and get in, the keeping the facilities cool, the building of the American electrical grid, the creating new power. All these are new jobs that don't exist today, so I don't worry about this. It might be a lull to a high. Sure, there might be more jobs let go initially and then more jobs added long term. We could see some of that, but I don't think it's that damaging. Next page, buddy. We talked about this. You can skip this one. This is the usage we're going to see. And then finally, I thought this was helpful. If you think about productivity, I mentioned this earlier, AI productivity. So share of generated AI users right now, you're looking at a scenario where they're saving 20% or more are saving 4 or more hours a week. 33% are saving at least 1. Now think about that. If you saved 4 hours a week, and instead of going home at 6 o'clock, you're going home at 5 o'clock, or whatever the case may be, just an hour back, does that mean you work harder or mean you get more quality of life? That'll be the fun story about AI. Does it enhance our quality of life, make us more productive, or both? This slide, if we get together a year from now, I bet these numbers will double. I bet it'll
Mhm.
be 8 down to 2.
All right. We'll see you in a year.
See you in
We'll
here.
compare slides.
Just the last slide here, just I think is an opportunity. Back to what I started with. If the experiment is right, that the U.S. economy grows, small caps will do well, higher yielding bonds will be great. Gold will have a sell-off because the dollar will strengthen. International stocks will do well, will benefit by the growth of the U.S. economy. And I like munis. If I'm wrong that the U.S. economy struggles and lower regulations, lower taxes don't have the impact I expect them to have, then buy bonds, wait for this to settle itself out, buy dividends and be paid to wait around. Gold will be a boom because the dollar will weaken. We're clearly in the bull case here, but I can understand why folks would be concerned about the bear case. I don't agree with it, but that's what the scenario would be.
Bull being a market, you're kind of saying the market's going to go up, the bear being the
Bullish.
market's going to go down,
Mhm.
right?
The economy and the market, which are usually not tied together. In this case, I would argue they'd be tied together.
And I think before, while we get into Q&A, and if you have questions, please do type them in the Q&A box there. There's two things I wanted to hit on. And one, I want to hear what your thoughts are, Phil, on what keeps you up at night. I know for me personally, I think what I'm seeing in kind of the economic data and as far as viewpoints that are out there, the greatest concern is if we lower interest rates too quick, too soon. And I think that while the interest rates were, the Fed, there's a lot of confidence lost in the Fed when, they said, inflation's transitory. They were too late to hike rates. They did aggressively. They do need to come down a little bit. But if we lower interest rates too much, or we have a pandering to any particular administration, I think that you could risk having inflation, really rear its ugly head again. So I think that that's one thing that keeps me up at night. I'm curious what keeps you up at night. And then the gold trade. I wanted to have you talk about the gold trade.
The one thing that keeps me up at night is, will the rest of the economy lift off to be able to support the growth of U.S. GDP? Because you said earlier, stock market's not inexpensive here. I had a slide on that. So I'm worried about that. Will this experiment work out the way I expect it to? That's probably my first one. And you'll see that in unemployment data. Specifically, for those who really care about what's happening in the economy, watch weekly jobless claims. Today, they're coming in around 220,000 per week. If that number accelerates to 260 to 270,000 per week, I would be concerned. Continuing claims, if they accelerate above 2 million, they come out every Thursday morning. If they go above 2 million, I would be concerned. And so far, they're not. So that's my canary in the coal mine. My second one is, I mentioned, is the size of the U.S. debt. I had argued we're at Dante's Inferno. We're in level one. And unless we want to become France, which is in a debt crisis right now, and we have to get control of the debt. We have to stop our spending. We have to decide on where we're going to spend the dollars we make, and we've got to grow the size of the U.S. economy so we can bring more tax dollars in to be able to spend on more things. But we have to let this play out. And if we don't, we become a deflationary economy like you've had in Europe. Think of it this way: there's not a European country today that's significantly bigger than they were pre-pandemic. They're only now modestly bigger. They haven't grown. Their populations are shrinking. They still have 6% unemployment. It's very different. Japan, remember Japan owned Rockefeller Center, and today they're another one in a debt crisis. So when I look at that scenario, we're on an inflection point, and that really has me worried for the long term. For the short term, I'd say stock market valuations are expensive. So to your point, I want to see AI and growth of the U.S. broaden out. But long term, I am worried about our debt and getting it under control.
So if we subtracted all these, the seven big tech companies, would we have had the growth in the stock market, or is that
No,
growth in the
you
stock
would have
market from
a
those?
solid return.
Yeah,
You'd be down to 6 and 7% rates of return, 8%. Back to my average slide. So when
yeah.
these companies go back to average annual returns, the market's going to have average annual returns. The trick is, can we, as your money manager, for those we get to manage money for, or for those who are managing your own money, can you pivot to other asset classes like a commodity, like international stocks, which finally look pretty good, or small caps, which I really like? Next year, my number one asset class of the year, I still think is going to be small caps. Will they give you value in above the S&P 500, in above what the NASDAQ does? Remember, the NASDAQ didn't make any money from 2000 to 2013. So at a time when we get to relative growth of the NASDAQ, I think there's other areas where you can do well in your portfolio. Probably diversification matters. It helps you limit risk when markets go down.
And while you
Okay.
hit on the gold trade in just a second, that we have an anonymous attendee that asked the question, for an IRA after retirement, which portfolio is better, 60/40, 50/50, or something else? I'm going to say something else. And that is really why you need a certified financial planner, because 60/40, 50/50 traditional portfolio investing is dead. So I think you really have to have an active, holistic and comprehensive plan that is really looking at your income needs, your tax efficiency, your distribution, your wealth transfer. And if they're not incorporating all those things, then they're missing the boat.
Not just about total returns, it's about everything else. I could agree with you more. Gold. Gold is a fascinating one because gold, we grew up with gold being an inflationary hedge. Inflation went up, you bought gold, a hard asset with a limited amount of supply and a perception of value. There's no real value to it because you can't use it for anything other than jewelry. So, and some very small manufacturing. But what's happened recently has never happened before. That because the entire world is in debt, gold has had two things driving it higher. One, a strong wedding season in China and in India, which demand for jewelry is up a bit. But more importantly, central banks around the world, whether you could name it the European Central Bank or more emerging markets to a degree, the Middle East, are buying gold because we've printed too much money. Since 2008, every country on the planet has printed too much money, especially us. So the reason why they're doing it is because gold still has this perception of value. I'm not sure I agree with it, by the way. Being up 50%. By the way, it's only recently reached an all-time high. The last time I had an all-time high was 1975 when inflation was running rampant. But my point is, it is this contra currency to the US dollar. It'll never be a currency again. It's just not big enough. I do worry about the size of the gold marketplace. There's a lot of stuff trading. But the entire gold marketplace is tiny. It's a couple $1 trillion. It's not very big. I mean, in the grand scheme of the world, it's not a big marketplace. So it's a speculative bet in a portfolio. And I'm never a big fan of putting speculative bets in portfolios when it's not based on a specific item like inflation, gold. When I'm buying it as a hedge to the rest of the world not being able to get their fiscal house in order, that worries me a bit. So I do think for those of you who bought it, wonderful, 50% this year. It's a great rate of return, 26% last year. Really impressive returns. I don't love why it's up, but I would say if in a scenario where the United States cannot get its fiscal house in order, nor can the rest of the world, gold's going to continue to go higher. So at some point, you might even see it in our portfolio as a reason to be contra the inability of every country in the world not being able to get it. It's why Bitcoin is up or was. Bitcoin sold off because of that's a long story. But gold tends to be this antidote to too much debt in the world. I think the world's going to get it right. I think the rest of the world, Europe is on that track, beginning to, Japan is beginning to. We are well on that track. As the world gets their house debt in order, I do think gold will sell off if that happens.
And last question, I'm going to squeeze this one in and then we're going to close it out. Any thoughts on de-dollarization and global nationalistic trend of countries? I know Phil talked about it in the very beginning. I think when over 90% of global trade is done in US dollars, I think that you're not going to get there with de-dollarization. It's just not going to happen. And then, globalization of trade, I'd argue that we actually decentralized globalization during COVID and really brought manufacturing to the US. And with AI and everything that we're doing with our own electricity and energy in the US, I would argue that we're actually seeing some decoupling of globalization would be my argument.
I would agree on both. The dollar today, oil, for example, oil still traded in dollars. 80% of the global oil supply is traded in dollars, 70 to 80%, depending on timing of the year. So oil is an example, but here's the real reason why. The U.S. economy, if you took all the other countries in the world, besides Europe and China, we're bigger than everyone else combined. If you take just Europe, we're basically two-thirds bigger. China, we're 50% bigger. There's no currency in the world that's in circulation enough to be able to replace the U.S. dollar. And when the U.S. consumer is just 25% of the global economy, really that's the underlying tenet why it won't happen. So no one's big enough. No one can handle the supply and the trade. But the reality is, I think our ability to be a diversified economy is the key driver. China is a two-trick pony. Europe is a two-trick pony. Russia's a one-trick pony. We have multiple industries that drive our revenue, and no one else in the world can say that. And that's why it's the case. But to the question asked, if in fact we don't get our debt in order, it'll speed this up. So instead of being 50 years from now when we lose it, it's probably more like 10 or 15. And what replaces it? Some sort of global digital currency. I know that's crazy, but I don't think it's out of the question to think that someday that may come. I think it's still the dollar because digitizing the dollar is well on its way, and the United States never wants to lose the ability to increase or decrease interest rates to manipulate the dollar. But digital is interesting. That's a whole nother goal. So that's that. And what was the second question? Forgive me, I forgot.
No, I think we hit was globalization.
Oh, I think there's been way too much made about that.
Yeah.
You're never going to get away from globalization. I do think Advil should be made in the United States. I do think we should have an aluminum smelter here. We used to have 50. Today we have basically zero. We're building 4 finally. I do think we could have a secure, more national grid for medicines and energy, to your point, Christina, that we have to have in case of a crisis like we had during the pandemic when we couldn't make our own stuff. So some of this will come back. And here's the thing. I know I'm not, please don't, I don't care about politics. I'm neutral. I don't care left or right. It means nothing to me. I need to make you money. But in that bill, the ability to build a new factory and write the whole thing off, very powerful. What if you could add back 10 million manufacturing jobs over the next 10 years that pay in excess of $100,000 to $150,000 a year? And you took our manufacturing trade, which our number one product is agriculture. Our number two is education. Nowhere in there is stuff. So what if you took our GDP from 11% manufacturing to 15 and added back 10 million jobs there? You would have a very strong U.S. economy. And this one piece of the bill might just do that.
All right,
Jim,
Phil,
I know you have a
Christine.
hard stop, so
Yeah, no,
thank
no. Hey,
thank everyone.
this has been fantastic. I think we've answered all the questions. This material will be posted on YouTube later, 6 p.m. Pacific time later today. And please join us or go to our website and sign up for our next webinar. Thank you for joining us. And Phil and Christina, as always, thank you for sharing your knowledge.